Hello and welcome to Trust Issues with me, David, from Kepler Trust Intelligence. Today I'm joined by Svetlana Viteva, co-manager of the Edinburgh Worldwide Investment Trust, which has the ticker EWI. Svetlana, thanks for taking the time to speak with us today.
Thank you for having me, David.
Now, EWI is in the AIC's global smaller companies sector and aims to invest in innovative, immature, entrepreneurial smaller companies. The one difference it has versus many of its peers is that as well as investing in publicly listed companies, it can also own private companies too. Now we'll come on to that in a little while. But Svetlana, first off, can you just give us a sense of what it is that you and your co-managers are looking for in the companies that you invest in?
Yeah, absolutely. Our investment philosophy is actually very simple. We're trying to identify tomorrow's winners whilst they're still early in their journey. So we're looking for growth, we're looking for an entrepreneurial mindset, we're looking for innovative solutions. And it's a philosophy which is very much based on this fundamental belief that problem solving is an inherent human trait. And the range of problems which the companies we invest in are solving is truly staggering when you look at them. It's things from building reusable rockets all the way to developing novel ways of treating diseases. And a lot of these businesses are genuinely redefining what is possible out there. So we look for these businesses while they are still in their formative stages, where they might be long on promise but short on evidence, you might say. And we look for them in the small companies universe. Now, an important point to note is that it's not smallness per se. We're looking for immaturity. Immaturity here in the context of the potential of the company, but also the opportunity it's seeking to tackle. Smallness, we've figured out, is a poor proxy for maturity. Most small companies are small for a very good reason. They do lack that scope to differentiate themselves or to grow structurally. Instead, we favor businesses which are building for the future in a very differentiated way, which means that they often have very little in way of competitors, if any at all. And that's actually a relatively small subset of our investment universe, which is otherwise 30 to 50,000 companies, depending on what source of information you use. The reason we like to go in so early with these companies is really to harness that asymmetry of equity returns and to benefit from the compounding of long-term growth off of a very low base. And when you think of past investments we've made in companies like Tesla and Dexcom, I think it illustrates really well the benefits of such an approach. Now, to find and to identify these high potential, immature businesses, there are certain things we're looking for. We're looking at the opportunity set, we're looking at the competitive positioning, we're looking at the quality of the management team and the scalability of the business. And these four traits effectively constitute our research framework. And just to give you a bit of a sense for what is it under each of these traits that we focus on. In terms of the opportunity set, we are very much looking for companies which are solving large problems. Now, these problems may be globally relevant ones or domestic ones. It doesn't matter as long as that problem presents a significant addressable opportunity relative to the size of the company. These are companies which tend to develop better, cheaper, more efficient ways of doing things than what is available in the market. And that's typically either due to technological differentiation or it's due to an innovative business practice or an innovative model. These can be outright disruptors, completely reshaping their respective industries, or they can be so-called enablers of problem-solving innovation in what are otherwise structurally growing areas. Now, as long-term investors, we obviously obsess with competitive advantage because it's the basis, it forms that basis of long-term sustainable growth. But because we go in so early in these businesses, we're focusing on exploring whether the ingredients are in place for that competitive edge to emerge and to build on itself. And in fact, some of our most exciting investments have been those where that edge has evolved and it has built on itself, compounded on itself, such that it's made it really hard for competitors to catch up and close that gap. I guess a good example from the portfolio today to illustrate this is a diagnostic company called Exact Sciences. And Exact started very much as a single cancer, single product company, but they're making very meaningful progress in building out that core expertise to resolve early stage cancers and are improving that resolution further, whilst at the same time they're really industrializing the process across several cancer indications. In terms of the management teams, we look to partner with those teams where we feel we are aligned in terms of the vision, ambition, the timelines, and where we feel that the team has the necessary skill set to turn what is a high potential idea into a commercial success. We are quite fortunate that a lot of the companies that we get involved with, there is still strong founder presence in some capacity or another. And these tend to be very passionate people, deeply motivated by these problems they're setting out to solve. So they tend to be quite critical, quite key in shaping the ambition and shaping the ethos of these businesses early on. And just to illustrate very quickly on the scalability, we do favor businesses with scaling advantages, whether that's in terms of pricing or distribution or just manufacturing business model. We like those businesses where returns improve with scale, very simplistically, like they get better as they grow bigger. And this, of course, is true when you think about asset-light digital businesses, when you think about online marketplaces with strong network effects. But it's also true in the context of healthcare, where solution can be used, an approach can be used to target very many different diseases. And we are, I guess, seeing the power of that approach with our investment in Alnylam, the leader in gene silencing. Alnylam's technology offers a scalable, a very repeatable platform which can be used to selectively silence faulty genes implicated with very many different diseases. And that's led to its pipeline to be really broad, really deep, including things from cardiovascular diseases to metabolic diseases, all the way to diseases of the central nervous system. So I hope, David, this gives you a good sense for what is it that we're trying to find in the companies that we invest in for Edinburgh Worldwide.
Absolutely. Now, Baillie Gifford in general is a big backer of private companies, especially within its investment trust stable. And as we mentioned briefly at the start, EWI is kind of a big part of that. What does this kind of part of the portfolio bring to the table for EWI?
Yeah, we have been using the flexibility within the investment trust structure to make these private investments in areas where we think are additive to the portfolio. So for us, it's not really about the appeal of private companies as an asset class. We invest in private companies because we want access to what we think are the most exciting, most innovative businesses out there seeking to solve some of the world's largest challenges. We have a very clear philosophy, we have a very clear process, and it's about finding those private businesses that fit with them, where there are few, if any at all, relevant and comparable businesses. The analysis that we do, the fundamental research that we do, it's the same, whether the company is public or private. And if anything, the hurdle rate for getting private companies into the fund is probably higher, and we want to have a higher confidence before getting involved, just because you can't easily reverse these transactions in the same way that you can with publicly listed equities. So when you look at the portfolio, I guess you will note that where we've been finding these exciting unlisted companies, it tends to be, I guess, in some of the more technological frontiers. When you think about SpaceX, which is transforming the economics of space, or PsiQuantum, which is making really good progress towards building that first optics-based quantum computer. And this allows us really to add extra diversity an asymmetric potential to the portfolio. And it's given clients access to some really fantastic private companies. I guess there is a subtle point in there as well, in that investing in private companies makes us better public investors, public companies investors. It allows us to be much more informed, to have a big picture view of the market and the competitive landscape as well. I do want to point out that we have used this flexibility quite sparingly. At the moment in Edinburgh Worldwide, there are only 10 private companies. They do account for 25% of the fund, but that is primarily a result of the success that we have seen with them. And we've seen companies like SpaceX and PsiQuantum. They've been able to raise more and more capital at higher and higher valuations. So in effect, the exposure to unlisted at the moment is very much a function of the success we've had with some of those names.
Now, we've obviously kind of touched on EWI's focus on innovation, its exposure to things like space exploration, quantum computing, and the healthcare applications. Are there any of the above that you're kind of particularly excited about and could kind of give us a bit more colour on today?
Yeah, I'd love to. I think we've spoken quite a lot about space exploration over the last couple of years, so I was hoping to maybe speak briefly about quantum computing today. For those that are still keen to hear more about space exploration, Luke Ward, the co-manager for Edinburgh Worldwide Investment Trust, has recently recorded a podcast on SpaceX as well, and I would encourage everyone interested to give that a go. But back to quantum computing and PsiQuantum, which is a private company that's looking to develop the world's first commercially viable quantum computer. PsiQuantum is perhaps the highest potential, the most transformative idea in the portfolio today. It's very much at the opposite end of the spectrum from SpaceX when we originally got involved with it. With SpaceX, we invested when it was starting to scale in its opportunity, whereas PsiQuantum is at an earlier stage and it's still proving out its core proposition that it can, in fact, build a commercially viable, scalable quantum computer. And just for that reason that we originally invested in it at a very modest position weighting, so we originally invested at less than 0.5%, just to take account of that more binary nature of the outcomes at that stage. Now, if PsiQuantum succeeds, it's truly going to be a paradigm shift in computing, and it's quite hard to imagine all of the advances that are going to follow on the back of that. But quantum computing is likely to unlock new methods for drug development and discovery, material sciences, quantum encryption, new solutions to climate change. So the reward really is huge if you are able to scale and to solve this. Now, within that space, our preference for PsiQuantum is because they've been focused on scalability from the get-go. They've been focused on making that solution, that approach, being very pragmatic. They're taking existing silicon technologies and making them work in a quantum way. And as an approach, it really stands out for its workability, for its practicality, and again, for its scalability. And I guess that approach and the company's expertise are increasingly validated by strong commitments from both the US defense agencies as well as the Australian government. So the company is now committed to building 2 quantum computing centers in each of these respective geographies, and it's already received $1.5 billion in order to do so. It plans to have these commercially viable computers by 2029, which is much, much earlier than what most people in the industry expect. The really exciting bit, I guess, with PsiQuantum as well is that they are looking to be more than just a hardware vendor. They don't want to just sell chips or just sell compute. They really want to own that whole value chain and to sell a solution to their clients' highest value, still unanswered question. So very, very exciting. As I said, probably the most transformative company we own at the moment, but at a much earlier stage still.
Now, the past couple of years have presented a number of headwinds for kind of small cap growth companies, but clearly, kind of maybe moving forward, there's more to be excited about. How do you kind of assess the backdrop for EWI's style of investing as we kind of move into 2025?
Yeah, it's definitely been tough for small growth companies. I guess after several years of macroeconomic headwinds, the backdrop in 2024 improved somewhat. We obviously saw inflation abate across key geographies, and central banks kind of moved accordingly to lower interest rates and to loosen their monetary policies. We saw that with the US Federal Reserve as well, which cut rates for the first time in 4 years since COVID. Investors began, at least, to broaden their risk appetite beyond the handful of mega caps which had dominated the market and the capital inflows up to that point. We also saw, I guess, very strong initial reaction on the US market when it comes to the presidential elections, on expectations that the policies of the incoming administration are going to be pro-growth, things like deregulation and a reduced corporate tax environment. More recently, however, expectations for further interest rate cuts have been tamped down a bit by the chairman of the Federal Reserve. And despite the reduction in these estimates, an environment of gradually declining rates is going to be a very favorable backdrop for investing in small companies and for our style of investing, especially in the context of the last few years of aggressive price hikes. Now, obviously, the market is very fickle and there is still lots of volatility, and we're not in any way trying to second guess what the central banks are going to do, which is why we are still sticking to trying to find companies which are doing things better, cheaper, more efficiently. And therefore, the value proposition is such that they will grow regardless of what the economy does. In that regard, Edinburgh Worldwide's portfolio will continue to earn its stripes over the coming years as these companies deliver on that operational progress. And we all know fundamentals, whether it's sales growth or earnings growth over the long term, will be rewarded in the financial markets. The other point worth noting, I guess, is that small companies' valuation look very attractive at the moment. Much of the recent underperformance of small companies has been down to multiple compression and valuation compression rather than to operational performance. Investors have just not been wanting to pay as they used to for the earnings of these businesses. And we've seen a really significant change in the PE multiples for global small cap indices, especially versus their large cap peers. Average small companies' valuation are now below their historic norms and at wide discount compared to the large cap companies. And the last time they would have traded so lowly, it is probably around the global financial crisis in 2008. That disconnect, that disparity is even wider when you look at US businesses. Now, obviously, we can't predict when this will change. We can't predict when this will normalize. But given just how tough the interest rate hiking cycle was on these businesses, it's reasonable to expect that gradual reduction in the interest rates is going to continue to be a trigger prompting reevaluation of this asset class as a whole, and I guess the portfolio that we manage.
Now, within the past couple of years, the headwinds that we've seen, certainly neither Baillie Gifford nor the EWI board has stood still, with a raft of adjustments made to things like the management structure and which companies that the trust can invest in, among many other things. Now, firstly, I'd encourage listeners to check out the announcement if they haven't already, and there's some more information about it in the most recent research report on the KTI website, as well as in our in-depth feature article from last weekend. Now, a couple of questions stem from this for Svetlana. First off, perhaps could we get a few words on what these key changes mean for EWI and the benefits that you see for shareholders moving forward?
Yeah, so these enhancements we announced after conducting a very thorough and a very robust review, and we did that in conjunction with our colleagues from the investment risk team as well, and with the support of the board of Edinburgh Worldwide Investment Trust. We are announcing, and we are changing several things. We are changing our investment decision structure, and we're moving to a portfolio construction group. And really the reason to do that is just to enable a more collaborative and more transparent decision-making process. We are introducing a new portfolio construction process, a new portfolio construction framework, which is going to be based on the financial maturity of the companies in which we invest. So the analysis that we did and the work that we did pointed to financial maturity as the key source of correlating risk for the strategy, with our least financially established businesses also being the biggest driver of volatility for the strategy. On the other hand, we saw that the most financially established businesses, those generating positive earnings and positive cash, they've consistently positively contributed to performance, and they've driven the bulk of performance for the strategy over the long term. So we really want to incorporate financial maturity explicitly when we decide on the structure of the fund. And we are going to break down basically the holdings into discrete buckets based on different financial characteristics that will follow companies as they progress from being loss-making to break-even all the way to generating positive earnings and positive cash flow. And we want to cap our exposure to those least financially established ones, both in aggregate, but also in terms of individual position sizes. And just for the avoidance of doubt, that's not to say we don't want to own these. We do want to own these. In fact, some of our most successful investments were made in these companies when they were in those stages of development. So companies like Tesla and Alnylam were very much in the least financially mature camp when we got involved. But we really want to be mindful of how much capital we have invested in these types of businesses and how big the individual positions are. And in fact, effectively, we are just kind of creating more competition for capital in these buckets. The other enhancement we're introducing is really just to strengthen the diversification guidelines. We want to access the broadest range of ideas possible from different industries, different sectors, and companies of different stages of development. I guess this is an acknowledgement of the fact that over the last few years, we did unintentionally skew our incremental idea generation towards companies in information technology and biotechnology, where it's easier to point to globally relevant problems. It's easier to point to technological differentiation as a source of competitive strength. But we really want to make sure we are properly leveraging the heterogeneity of our asset class and really want to put guardrails against unintentional industry concentration.
Thanks, Svetlana. Now, after the publication of the board's proposals, we saw a competing set unveiled by the activist investor Saba Capital, which has taken a decent stake in EWI, which amounts to replacing the directors with their own, potentially offering a cash exit and potentially also a rollover into a strategy managed by someone of Saba's choosing, which is most likely to be Saba itself. Now, there are a few things to kind of be ironed out. The date for the vote hasn't yet been arranged. Now, clearly, the board has already stated its clear opposition to Saba's plans, which amount to a big overhaul in investment strategy. Because if Saba were to be appointed as manager, it sounds like it would start investing in discounted closed-end funds rather than the innovative and entrepreneurial and exciting companies that EWI currently invests in. Now, for those hoping to stay invested in EWI's current strategy, it's important that they do vote, and we have an article coming out on the KTI website this weekend outlining how they can do that on the different platforms that they invest, and I'll link to that in the description of this podcast. Now, Svetlana, what would you say to EWI shareholders currently considering their options ahead of any vote?
We believe that Edinburgh Worldwide in its current form is a very attractive proposition for long-term investors who want to have exposure to what we think are the winners of tomorrow, both in the public and the private space. Our differentiated approach has been critical in helping us identify companies like Tesla and Alnylam, Dexcom early on in their journeys, and is giving access to companies like PsiQuantum and SpaceX, which retail investors otherwise would have a very difficult time getting access to. We believe we have compiled and assembled a very exciting portfolio of high potential companies, many of which are yet to become such high household names. And we are very optimistic about their prospects, with sales and earnings growth expected well ahead of the benchmark. The opportunity for a strategy like this is as large as it has ever been. The small cap universe is just unparalleled in its appeal. It's such a fertile hunting ground for the most rapidly growing, most innovative businesses. It's very much an active stock pickers market, but if you do find these companies early on, the rewards really are substantial. And we've actually gone back and looked at the data for US companies over the last 2 decades, and not only do small companies have a 50% higher chance of delivering a 5x return compared to their large cap peers, but there are 9 times as many small cap companies delivering such outcomes compared to large companies. So it really is quite striking. And we in Edinburgh Worldwide have already demonstrated we have a higher hit rate in finding these than the benchmark. And we believe that with these process enhancements, we are going to be much better owners of these shares and these businesses as well. So Saba's intention, as you say, seems to be to change this investment mandate, a mandate which shareholders have actively chosen to invest in. And that's why we believe it's very important for the shareholders to have a say in the future of this trust. And every vote will be important, and I do hope that shareholders will go out and cast their vote.
Sure. And yeah, I would definitely urge you all to cast your vote. We suspect that Saba is relying on retail investor apathy to force through their resolutions, because historically, it is difficult for retail shareholders to kind of figure out how to vote to use their vote at general meetings. Fortunately, I think that a lot of the investment platforms are making it easier to vote, and hopefully you should get an email or a secure message from your platform telling you of the vote. That democracy is a key kind of selling point of investment trust in general, so I would urge you all to use that right. Now, I'm sure that listeners will agree that was a fascinating discussion about what looks to be an exciting portfolio of companies. Svetlana, thanks for your time and your insight today.
Thank you for having me, David.
Now, we do have a feature article on investing in innovation, focusing on healthcare, but with a nod to a few of the other enduring themes that we've touched on today. Don't forget to check out the KTI website too, where you'll find our recent research note on EWI. Again, both will be linked to in the description, as will the EWI website, where you'll find more interesting insights, including Luke's podcast that Svetlana mentioned on SpaceX. Thanks for listening today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.